Welcome to this video on what is hedging in finance. Hedging is an essential concept in finance that can help individuals and companies manage risk and protect themselves against losses. In this video, we'll explain the concept of hedging, its types, and its importance in finance. So, what is hedging? Hedging is a strategy used to reduce or eliminate the risk of adverse price movements in an asset. It involves taking an opposite position in a related asset to offset any potential losses from the primary position. To understand hedging, let's consider an example. Suppose you're a farmer who has planted a crop that will be ready for harvest in 6 months. You expect the price of the crop to rise by then, but there's a risk that the price may fall due to unfavorable weather conditions or other factors. To protect yourself against such a risk, you can hedge your position by entering into a futures contract for the crop. This contract will allow you to sell the crop at a predetermined price 6 months later, regardless of the actual market price at that time. In this example, the farmer has effectively hedged against potential losses due to adverse price movements. By entering into a futures contract, the farmer has locked in a price for the crop, ensuring that he can sell it at a profit, regardless of the actual market price at the time of harvest. Hedging is an essential risk management tool that allows individuals and companies to protect themselves against potential losses. It's particularly important in industries such as commodities, where prices can be volatile and unpredictable. By hedging their positions, companies can ensure that they can meet their financial obligations and avoid catastrophic losses. There are different types of hedging, such as forward contracts, futures contracts, and options contracts that can be used depending on the specific needs of the parties involved. Let's take an example to understand it better. Suppose you're a multinational corporation that has to pay a foreign supplier $10 million in 6 months for goods that you've already purchased. The exchange rate at the time of purchase was $1 USD to 0.85 euros. However, due to the volatile nature of exchange rates, there's a risk that the exchange rate may change by the time you have to make the payment. If the exchange rate falls to $1 USD to 0.80 euros, you would have to pay 12.5 million euros, which is more than what you had originally planned for. This could result in a significant loss for your company. To protect yourself against this risk, you can hedge your position by entering into a forward contract or a futures contract. Let's consider a forward contract for this example. You can enter into a forward contract with a financial institution to sell $10 million USD in 6 months at the current exchange rate of $1 USD to 0.85 euros. This means that regardless of the actual exchange rate at the time of payment, you can sell the USD at the predetermined rate of 0.85 euros per USD. If the exchange rate falls to $1 USD to 0.80 euros, you can still sell your USD at the predetermined rate of 0.85 euros per USD and receive 8.5 million euros, which is sufficient to pay your supplier. If the exchange rate rises to $1 USD to 0.90 euros, you may regret having hedged because you would have received fewer euros than the market price. But the peace of mind you get from knowing that your costs are under control may outweigh the potential profits you would have received. By hedging your position, you have effectively eliminated the risk of adverse exchange rate movements, allowing you to plan your costs more accurately and avoid losses. This is just one example of how hedging can be used to manage risk in finance. Now, let's look at the types of hedging. There are 3 main types of hedging: forward contracts, futures contracts, and options contracts. 1. Forward contracts. A forward contract is a customized agreement between 2 parties to buy or sell an asset at a specified price and date in the future. The 2 parties involved in the transaction agree to the terms of the contract, which is not traded on any exchange and is unique to them. In a forward contract, the price and date of delivery are predetermined, and the buyer is obligated to buy the underlying asset, while the seller is obligated to sell it at the agreed-upon price and date. The asset can be a commodity, currency, or any other financial instrument. The price is fixed at the time of the contract, and it does not change, even if the market price of the asset changes during the period of the contract. Forward contracts are used as a tool for hedging against future price fluctuations of the underlying asset. For example, if a company knows that it will need to buy a particular commodity at a specific time in the future, it can enter into a forward contract with a supplier to purchase the commodity at a predetermined price. This will protect the company from any price increases that may occur in the future. One of the benefits of forward contracts is their flexibility. Since they are not standardized, they can be customized to meet the specific needs of the parties involved. They can also be used to lock in a price for an asset, which can be beneficial for businesses that rely on stable pricing to manage their costs. However, forward contracts also have some drawbacks. Since they are not traded on an exchange, there is a risk of counterparty default. If one of the parties involved in the contract fails to fulfill their obligations, the other party may face financial losses. Additionally, the lack of a secondary market for forward contracts makes them less liquid compared to other financial instruments. 2. Futures contracts. Futures contracts are a standardized agreement between two parties to buy or sell a specific underlying asset at a predetermined price and date in the future. The underlying asset can be anything that has a market price, such as commodities, stocks, bonds, or currencies. Futures contracts are traded on exchanges, which act as intermediaries between buyers and sellers. The exchange sets the terms of the contract, including the underlying asset, the quantity, the delivery date, and the price. Futures contracts are standardized in terms of their size and delivery date, which makes them easier to trade and more liquid than forward contracts. One of the main benefits of futures contracts is that they can be used to hedge against price fluctuations. For example, if a farmer expects to harvest a crop in 3 months and is concerned that the price of the crop may fall by then, they can sell a futures contract for the crop at the current market price. This way, the farmer locks in a price for the crop and eliminates the risk of price fluctuations. On the other side of the transaction, a buyer of a futures contract is betting that the price of the underlying asset will rise in the future. If the price does rise, the buyer can sell the contract at a higher price and make a profit. Futures contracts are settled on the delivery date, which is the date when the buyer takes delivery of the underlying asset. However, most futures contracts are settled before the delivery date through a process called offsetting. Offset occurs when the original buyer or seller of the futures contract takes an opposite position in another futures contract with the same specifications. This way, they can close out their position without taking physical delivery of the underlying asset. 3. Options contracts. Options contracts are financial instruments that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and time. The underlying asset can be anything that has a market price, such as stocks, commodities, or currencies. There are 2 types of options contracts: call options and put options. A call option gives the holder the right to buy the underlying asset at the predetermined price at any time before the expiration date of the option. If the market price of the asset increases above the strike price, the holder can buy the asset at the lower strike price and sell it at the higher market price, making a profit. A put option, on the other hand, gives the holder the right to sell the underlying asset at the strike price at any time before the expiration date of the option. If the market price of the asset falls below the strike price, the holder can sell the asset at the higher strike price and avoid losses that would have occurred if they had sold the asset at the lower market price. It's important to note that options contracts have an expiration date. Once the expiration date passes, the option is no longer valid, and the holder loses the right to buy or sell the underlying asset at the predetermined price. Options contracts are often used for hedging, as they allow investors to protect their positions against adverse price movements while still allowing for potential gains if prices move in the desired direction. They are also used for speculation, as they offer the potential for significant profits if the market moves in the holder's favor. In order to trade options contracts, investors need to open an options account with a broker that offers options trading. They can then buy or sell options contracts on various exchanges. The cost of the option is determined by a number of factors, including the price of the underlying asset, the strike price, the time until expiration, and market volatility. Now that we've discussed the types of hedging, let's understand the importance of hedging in finance. Hedging is an essential risk management tool that allows individuals and companies to protect themselves against potential losses. It's particularly important in industries such as commodities, where prices can be volatile and unpredictable. By hedging their positions, companies can ensure that they can meet their financial obligations and avoid catastrophic losses. In conclusion, hedging is an essential concept in finance that allows individuals and companies to protect themselves against potential losses. There are 3 main types of hedging: forward contracts, futures contracts, and options contracts. Each type has its benefits and drawbacks, and the choice of the type of hedging depends on the specific needs of the parties involved. By using hedging, individuals and companies can manage risk effectively and protect themselves against adverse price movements.